Interest rate buy downs. How in the world does this work? I know there's a lot of talk about it, but what does the math look like? So I'm going to hopefully clear that up for you right now and give you some examples of what that looks like so that you're a little bit better armed for discussing with your clients and just have a more thorough understanding. So there's two different things we're going to talk about today. One of them is just buying down the rate, buying points. What does that mean if I buy a point? We're also going to talk about the 2-to-1 buy down or the 3-to-1 buy down also, which is a cool feature that has become very prominent lately with these higher rates. But first of all, let's just take a look. I'm going to share the screen real quick. Let's take a look right now at just the mortgage interest rate chart for the last year. So if you guys can see this chart right now, you'll see that this thing has been on a steady decline since the very beginning of the year, first business day of the year, and it's gone down. So that's the market. And that's where interest rates come from, right? Is the mortgage-backed security market. And they're traded on Wall Street like any other stock or bond. So today, first thing we're going to tackle is the buy down. So just, I want to buy my rate down. I want to buy a point. What does that look like? So I'm going to share the screen with you right here and just give you an idea. So this is a scenario I just priced out for you. It's a VA purchase, San Diego County, $750,000 loan amount, 0 down payment. So this is what we did. They are not exempt from the funding fee in my example. So the payment amounts include the funding fee attached to that. So if you take a look here, I highlighted in blue what I would consider the par rate. And what this means is if a client called me on the phone and said, hey, here's my credit, here's all my info, what's the rate today? I would quote 5%. And the reason I would quote that is if you see on this column right here, this is the cost or credit for the rate. So every interest rate, as you can see here, has an associated cost or credit available to it. And so when someone asks me for the interest rate for the day, I want to give them the interest rate that is the closest to 0, the closest to no additional cost, and the closest to no credit. Now, there isn't always a 0 available. So in this case, 5% has a very small lender credit. You can see indicated there with the minus sign in front of it, a minus 0.156. So if someone decided to move forward today, lock in that rate, they would be getting just to the right of that, $1,170 as a lender credit at closing for taking that 5%. Now, there isn't a 0 today, meaning no cost or no credit. So the next one down is 4.875. So we're right in between there. This has almost an identical cost on the flip side, 0.154. So if they wanted this rate, their closing costs would increase by $1,155. So let's talk about this. I want to buy a point. All right. Well, when I look at my rate sheet and someone says, I want to buy a point, I'm looking, okay, what rate costs close to 1%? So in this example right here, 4.5% is costing 0.868 points. So 0.868 is 0.868% multiplied by the loan amount, which gives us the dollars right here to the right, the 6,510. So if they wanted 4.5%, it would cost them an extra $6,510. The points is 0.868. Now, there isn't an even 1 point buy down. The next one is 1.3. You can see that jumps the cost to 10 grand. So when we're looking, and you guys are asking, for what is the rate if we get a 1 point buy down? Well, these numbers change all the time. Multiple times throughout the day, these can change, and every day they change for sure. So tomorrow, 5% might be at 0. Or maybe it's paying back a little more, or maybe it's costing what the 4.8 is today. We don't know where the rates are going to move tomorrow, but that's likely what could happen. And all of these figures on the cost or credit column are subject to change at any time, just as the trading on Wall Street happens continuously. So these can vary. So there's never going to be like, hey, I got my borrower pre-approved today. 2 weeks later, we get into contract and we're planning on buying down a point to get them to 4.5. Well, in 2 weeks, maybe that only gets them down to 4.875. Maybe the market moved quite a bit, right? And so it doesn't hold steady, and it doesn't necessarily mean 1 point, paying a point doesn't get you a full point in interest rate reduction. So if you'll see here, if someone wanted a 4.125, so we're close to a full percentage point lower in rate, it costs them 2.25 points or $16,000. So it's not an even 1-for-1 exchange. And I think that's a piece that gets confused a lot, is they figure on buying a point. So a point equals a point. in rate, and that's not necessarily it. So these points are determined by where the investor appetite is on Wall Street for mortgage-backed securities. So in theory, what they're saying is, we're not real interested in giving you 4.25 or 4.125, sorry. And that's why they make it charge so much. Now, conversely, we can go the other way. And I know the market has shifted some, and now we're able to negotiate some seller credits, but this hasn't always been the case. So if we go above this par rate, you'll see these are continuing to be minus signs in front of the rate. Well, all of these minus signs are a credit. So if someone wanted, the largest credit on my rate sheet today, they could take a 5.75 rate on this VA deal, and we would credit them $8,800 at the closing. So hopefully that clears up buying a point. I want to buy my rate down. If not, call me. I'll walk you through this, or email me, and we'll schedule some time to go over it. Now, here's the other hot topic thing, right? And hopefully you guys can see this. So this is the buy down. So this is the hot thing you're flyers on. All the loan officers are calling you saying, hey, I got this really amazing whiz bang product. So put in the loan amount. This is our loan amount on the same scenario with the funding fee. Our par rate was that 5%. That's what I'm using here. And so what this is showing us is our principal and interest, our monthly payment on that loan. Well, we know there's 12 months in the year, so there's 12 payments, 360 total payments. So what the buy down is, and I'll use the 2-to-1 buy down. It's a little more simple. But what it is basically the ability to drop the interest rate 2 points for the first year. And then the second year, it's only dropped by 1 point. And then third year, it goes back to the initial 5% or the qualifying rate. So what does this mean? So this means there are some costs, some additional closing costs due. So how this works is they're basically taking the 5% interest rate payment, as you can see right here, I'll highlight it. So this is the interest rate payment on 5%. But we know year one, we're going to be at 3%. So the payment on that is $32.64. What we have to do at closing is we have to account for that delta. So the difference between these two every month is $884. So we've got 1 year while we're at the 3%. So we got to take that 884 times 12. That's 10,608. Now we do the same thing at 4%. What's the difference between the 4% payment and our 5% payment? Well, that's $455 times 12 is $5,400. So at closing, in order to do the 2-to-1 buy down, they need $16,077 to make this work. So the advantage of this obviously is getting somebody in at a rate and a payment that is more attractive. And the hope is that the seller will pay for this buy down cost. So it really is a true buy down for the buyer. And the average homeowner stays in their mortgage about 18 to 23 months. So there's no prepayment penalties on these. They can refinance when rates come down. On the VA loan, it's great because there's no appraisal or income docs and stuff. But this would work for conventional loan, FHA, all the same thing. And there's a 1-0 buy down, just buying it down a point. And then there's even the 3-2-1 buy down. We can get all the way down 3 points, but you can see our closing costs in this example get up to 31,000. So it can get really, really pricey the more you try and do that. So I hope that this helped to clear up I want to buy my rate down, I want to pay points, or the 2-to-1 buy down or 3-2-1 buy down. Now I'm not a tax advisor, but if you double check with a CPA or an accountant, the point. So if we did the first example, right, we're just going to buy down the interest rate at closing. So we're going to do one of these things. Maybe we're going to buy it down to 4.5. If they did that, the points they paid, they can report that on next year's tax returns. And there is some tax benefit there as well. So definitely a really good, powerful tool. Hopefully that clarified things for you. Feel free to share this with your clients too, because I think having this explanation will clear some things up with them. There's just a lot of confusion of points and where it gets me and all that stuff. So just remember that paying a point doesn't necessarily give you a point in interest rate reduction, and that buy down amount fluctuates daily, just like interest rates fluctuate daily, depending on where the investor need and allocation is on Wall Street. Hit me up if you have any questions. My personal cell is 760-217-0820, or you can email me, jwood@valoanguy.us. Have a great one.